All right, guys, welcome back. So we're going to talk about just a few additional financing options for you to be able to get into real estate. And these are, I call these leveraged financing. Now, all financing, you're leveraging money, but in this case, we're leveraging our own assets. Okay. So essentially what you're doing with this type of financing is you are using your existing assets as collateral to get loans to then go buy other assets. Okay, now we talked about this a little bit in the stock market section of this module. We talked about some of these. We're going to go over some of those again. But essentially, the idea here is you own an asset, it's working for you. Okay, it's doing its thing, and you're just getting to loan against the value. So you're not taking money out of this asset, you're loaning against the asset to then go buy additional assets. So essentially, you have money working in two places. The cost is the interest that you pay on that loan, which can be fairly low, as we've seen in some of these cases. But the interest cost can be fairly low, but essentially you have money working in two places at once. It does increase your risk, as we've talked about, and we'll discuss that more, but it can be a great option to stretch your dollars and let them work doing more for you at the same time. Okay, so here are some additional ways that you can do this. So number one, you can get a personal line of credit. I guess in here, actually, first I should have put credit cards, okay? So you can use credit cards to do these things. Now, the interest rate on credit cards is extremely high, but there is no collateral. They're unsecured loans. And so there's no claim on any of your assets necessarily for this, but the interest rates are extremely high. So you might be able to use this for very, very short-term purposes, but certainly not long-term, or else everybody would do this with credit cards. So they make the interest rates high enough that they discourage everybody from trying to do this. But it can work as a very short-term type of funding option in some cases. Now, you can't necessarily go use credit cards to buy real estate. You kind of can. You can access them as cash, and take a line of cash against your credit to go purchase real estate. That's very, very risky, right? High interest rates, but it has been done, okay? But personal lines of credit are essentially, they look at your credit worthiness and they say, hey, based on your income, based on your assets, yeah, we'll give you a line of credit up to this amount. And usually with these lines of credit, you go out, take out the money, and you just pay monthly interest payments, okay? Interest only. So you don't have to pay back the interest and the principal traditionally. It's just the interest that you're paying on. So it's a lot less of a cash flow burden on you. And you can take this money and then go use it however you want, essentially. So if that's to go and get into a property or whatever you need to do. Okay, so personal line of credit. Home equity line of credit also works. You can do a home equity line of credit on your primary residence. You could do it on an investment property if it has enough equity. So these home equity lines of credit, we've kind of talked about how they're structured or how they work in previous videos. But essentially, you could tap into equity in your home or in a property to then turn it into cash to go do another thing. So you're not selling your home. Your home is still there. It's still gaining in value, hopefully appreciating, but you're loaning against it, accessing the equity, turning it into cash to go purchase another asset. Now, some people just use HELOCs to go spend the money. That's also okay. But if we're talking about leveraging your own assets, this is how it is done, okay? Cash value life insurance is another way that you can do this. It can be very popular among real estate investors to use this method. And we'll talk more about permanent life insurance and the benefits and some of the mechanics around cash value. But essentially, the principle is that you buy a permanent life insurance policy, typically whole life, and part of your premium that goes to fund your death benefit, okay, over however many years for your life expectancy. And then part can start to go into build up cash value within the actual insurance policy. Now, if you structure it in a very specific way, you can actually ensure that the majority of the premium you pay becomes cash value instead of going to the death benefits. You decrease the death benefit and you increase the amount of premium you pay for the death benefit. I know that sounds counterintuitive, but in this case, you're not really worried about the death benefit. You want the cash value. So we'll talk more specifics about this because there are ways that you will break the policy and it won't work as well. But that's the principle. You put in the highest amount of premium for the lowest amount of death benefit, meaning that the portion of your premium that goes to fund the death benefit is very small, and the majority of this goes into cash value, okay? So you would do this and you would fund this over a number of years. Well, if you fund it, then all of a sudden you have, let's say, $50,000 in cash value, then you can actually, this money is earning a guaranteed interest rate, right? The insurance company has guaranteed an interest rate specified in your policy. They could be earning dividends as well, but let's say it's 4 or 5% interest, guaranteed interest on that cash value. So it's growing at a steady, slow pace, but steady and guaranteed. You're not losing value. And you can actually go and take a loan against your whole life cash value balance. You can loan against it and go do whatever you want. Okay, so your actual cash value is still there and still earning its 5% interest, but you're using it as collateral. You're taking a loan against it from the insurance company. Okay, you pay your interest only payments back into your account, but then you have the cash value to go do the same thing. Okay, so it works essentially like a HELOC or an S block, which I'll cover next, but you're loaning against the cash value in a life insurance policy. Okay, so that type of an asset. Okay, same principle, different asset. And then the S block or securities-based line of credit, again, if you have a large portfolio of stocks or equities or securities of that type that are traded on the public markets, based on the composition of that and the risk in your portfolio, then you can get securities-based line of credit up to a certain percentage of the value of that and just, again, access cash, make interest-only repayments, monthly interest-only payments, but use that cash to do whatever. So you still have the actual portfolio of your securities that is growing, hopefully, right? It's going to fluctuate in value, but hopefully you're getting more growth out of it. And then you're also accessing cash to go purchase another asset like real estate, and you just have the cost of the interest. So these are all ways you can leverage your own assets to do this. And I will tell you that very wealthy people do this all the time. Why would you go sell if you want cash, why would you want to sell an asset that is growing, give up the future growth, and also pay taxes on that growth, right? Because you have capital gains tax. Why would you want to give up the future growth potential and pay taxes just to use the money to do something? Okay, it doesn't make any sense, especially if you're in a very high tax bracket. Your capital gains, even if they're long-term, can be higher. They could be 20% instead of 15%. It's just unnecessary tax. So you can just go get a loan and collateralize cash value in your life insurance policy, home equity, personal line of credit, or your actual portfolio, pay 2, maybe 3% interest only monthly payments, and access a ton of cash. 3% in interest is way less than giving up the future potential growth of your asset plus capital gains of 15 or 20%, right? It's much, much less expensive to just keep your assets as they are and loan against them to use the cash for whatever you want and pay a very low interest rate, okay? So this is what people do. In fact, this is what they do oftentimes to fund their lifestyle, okay? They want to go buy a new house. They just loan against their assets to go purchase a house instead of selling their assets to go buy a house. So this is used commonly because it just makes sense. The numbers work out. Now, the one warning I have to put here, and I've talked about it before, you do not want to be over leveraged, especially in personal assets, right? Things can go sideways and things can go wrong. And if you don't have some margin of safety or some buffer there, then things could go really wrong for you, right? This happened during the 2008 crisis where people were over leveraged in real estate and they had second mortgages or like a home equity loan or a home equity line of credit that they used the money. And so essentially they have 2 liens on their house and maxed out the equity in their home. And then the home equity dropped by 10, 20, 30%, right? Home values just got chopped down. So all of a sudden they have an asset that's worth this much, but they actually owe this much, okay? They over leveraged and underwater in their properties. And the only thing they could do was walk away, right? That was it. Walk away. And, the banks are out of a ton of money, filing bankruptcy or whatever these people had to do. They were underwater. They got so confident in a hot real estate market and a hot economy that they were over leveraged, overconfident, and it blew up in their faces. So this can happen on all of these things, right? Especially if you do a home equity, if you're loaning against your home equity line of credit on your primary residence, you're putting your family at risk here. So you could take the money, but if you over leverage and values drop and all of a sudden you have to owe money back that you don't have, you could lose your home. That's serious, serious consequence, right? The same thing in a securities-based line of credit. The security could drop in value. And they call it, and you have to repay the loan immediately. And guess what? You don't have the money. So they start selling away your assets at their discretion. Okay. So all types of ways to be over leveraged. There's substantial risk, just like you're over leveraged, just like you're leveraged to gain, to get outsized gains. If things go sideways, you could get outsized losses and really, really take a huge hit. So you have to proceed with caution here. You have to understand the risk involved and make really good decisions. And if you're married, do not make these decisions alone. This is not unilateral. You both have to be on the same page, understand the risks, because you don't want one person to decide, things go bad, and then there is a lot of resentment, a lot of blame, and that can destroy relationships. Okay. So you win and you die together. You got to be totally on the same page, dialed in. And again, tie this all back to your why, what your lifestyle is. If this is presenting so much stress that you can't sleep at night, then that is not worth it. Tone down the risk. You don't need to move that fast. Just tone it down and move at a nice, easy pace where you can actually sleep peacefully at night. So there's a lot more than just money that goes into this. There's a lot of emotions tied in, and you just don't want to get into a position where you're taking on too much risk and you can't handle it. Your heart can't handle it, or your relationship can't handle it, or your actual money can't handle it. Okay. So that's a little bit about leveraged financing on your own assets and how to make your money stretch further. So we'll see you guys in the next video.
Smart leverage starts with discipline.